Hello there, Stephen Thomas with Reports on Housing, and we have yet another housing debrief. First, I wanted to dive right into the what's going on in the market right now. Here we are at July 19th, and it's a Friday. What is going on is finally we've seen interest rates come down. They're below 7%. We haven't quite yet seen much of it in the data yet. We need a couple more weeks and we need duration in order to start to see it in the data. But in talking to a lot of mortgage representatives out there, mortgage consultants are telling me that their phones are ringing a lot more than where they have over the last couple of months. So with that said, demand is continuing to follow a normal summer pattern, and that's where inventory is rising and demand is falling. And when you get a rise in inventory that's accumulating homes on the market and you get demand that's falling, overall market times are growing. So homeowners, sellers cannot get ahead of themselves and think that all of a sudden the market's going to go bananas because interest rates have dropped below 7%. Shoot, they're just below 7%. So they're not that far below 7, but they're making their way lower, and they'll continue to do so. So we should see a change in the marketplace going forward, just not yet. So this week we're going to be talking about Yikes, housing payments and affordability. And there are a lot of people out there, I hear it all the time, and people say, and I even overhear conversations, they say interest rates have been a lot higher than where they are today. So shoot, in 1981, I had an interest rate at 16%. So, and I hear this a lot. 80s is what was home to the highest mortgage rates pretty much that we had seen in at least modern times. And if you look at in 1980, the average interest rate was 13.75%. So yes, higher than where we are today. And in 1981, we were at 16.65% was the average for the year. It hit all the way, surpassed 18%, but that was the average, 16.65%. And in 1990, we had 10% interest rates. And in the year 2000, we had 8% interest rates. And we had 8% interest rates in October of last year, and people were absolutely freaking out. And in 2024, according to Freddie Mac's mortgage market survey, it goes all the way back to 1972, you're looking at 6.77% interest rates. That's where we are right now as of this week. But we're gonna throw it back to the 1980s, 1981, and talk about where home affordability is at. If you remember 1981, that's when you had these cassette tapes because I have white hair, I know what this was like to stick into my Walkman and it would get stuck. You pull it out and then you have to take a pencil and fix it. That makes me old. If you don't know what I'm talking about, don't worry about it. These tapes will never come back into vogue. But we're going to talk about home affordability, and we're going to start with 1981. And what goes into home affordability is, yes, everybody jumps to the conclusion it's all about price, but it's not just about price. You also have to consider interest rates. Interest rates is important, so we have home values, interest rates, where they're at for the day, as well as where our incomes. You have to factor all that in taking a look at where home affordability is at. So, and we're going to do that for you. We're going to go just about decade by decade practically. But first, we're going to dive into 1981. But initially, and before we dive totally into it, we got to head to our sponsor, and our sponsor is Lee McMahon, and she does an absolute wonderful job at Movement Mortgage, and you can contact Lee directly at 949-239-4252. She knows so many different programs inside and out. First-time homebuyer programs, special programs. She's got it all dialed in. There's these first-time homebuyer programs where they have Cal FHA. If you don't know what this is a program. It's a direct lender program, as well as Fannie Mae. They have Golden State Financial Authority. There's all these different programs. She knows them all backwards and forwards, way more than definitely myself. But she knows how to dive into this stuff, and she's been doing it for quite some time. And they have a Movement Preferred Jumbo Express. They have a great jumbo programs, kind of needed for Southern California and the rest of California. And they get some extra buying power. She's got this movement purchase power that she has, makes stronger offers that stand out against a flood of other buyers without contingencies or costly bridge loans. And She's about helping more buyers get their dream home. They have upfront underwriting, 7-day processing, 1-day closing goal. So once all the conditions are met, they're able to she's able to dial this in. She's got a great team that works for her. And by the way, she is president of the Orange County chapter of the California Association of Mortgage Professionals. And there is an annual conference that is coming up on August 4th to Wednesday, August 7th. There's speakers Ricardo Lara, the Commissioner of the Department of Real Estate, and Commissioner of the Department of another one, Chica Sunquist, also the Commissioner of the Department of Real Estate. I know the Department of Insurance is talking. Rob Crispin from Crispin Commentary knows mortgages inside and out. And I'm going to be speaking about the California housing market as well. So at Movement Mortgage, the Movement Mortgage makes a difference. And she definitely makes a difference. She has unique options for all of the borrowers that she works with. Lee McMahon, directly, you can contact her at 949-239-4252. Thanks, Lee, for your continued support. We appreciate it. Now back to the program. We're going to dial into 1981. And in 1981, that's when we had rates of 16.65% on average. And the median home price was $108,000. This was higher than the United States in California. Not by a lot, but it was definitely higher at $108,000. The median income was $22,390 for everybody in California. The down payment that was required, if 20% down, was $21,600. So pretty much one annual income was how much your down payment was. And the payment with that 20% down was $1,207. So $1,207 per month was 65% of a borrower's monthly income, which was outrageous, which meant that demand had really squeezed down. There wasn't a whole heck of a lot of demand when interest rates were at 16.65% or even higher that year. So that is when things were extremely unaffordable, was in 1981. So they're right. When they had these high interest rates, boy, was it unaffordable. In 1990, there were 10% interest rates. And the median home price now is at $194,000. So a lot more than the just over $100,000. So it's $194,000. The median income is now $33,290, and the down payment with 20% down is $38,800. So the payment on a monthly basis was $1,362. Now keep in mind, remember that was only $1,207 in 1981. Because interest rates had come down all the way to 10%, now you're looking at a payment of just $1,362. As a matter of fact, now it's only 49% of the monthly income of a Californian for the median house detached home in California. So went from 65% to 49%. And in the year 2000, interest rates had come down to 8%, but the median house price had ballooned all the way to $241,000, and median income had grown to $47,000. So the down payment that was required was $48,200, right around median income again. The payment was $1,415, and the percentage of the monthly income was only 36%. And I say only because that's in comparison to 65% in 1981 or 49% in 1990. 36% is a lot more doable. And so that's what was going on in 2000. In 2024, I wanted to compare that to where we are today at 6.89%. Now, remember, we were higher, but at 6.89% today, the median home price in California for the month of June for all of California detached was $900,720. The median income is now at $92,000, and that's we kind of did an average increase because the last time a median income was reported was 2022. So you got 2023 and then 2024 where we're at today. So 92,000 is about an estimate, and the down payment is 180,000. Now we're looking at double the median income for a year is what the down payment is in all of California. The payment now has jumped to $4,741 per month. That is a lot higher than where it was when it was in year 2000, we're at $1,415. So at 2000, $24, that is 62% of the monthly income. So it's even higher than 1981, where we're at today. And remember that interest rates were even higher. They hit 7.5% 3 times in the month of April. So 3 times in the month of April, we hit 7.5%. Shoot, they were at 8% back in October. So at 6.89%, we're at 62% of the income. It was a lot more percentage of income back in October or as early as April, just a few months ago. So, but in 2025, we see a pathway for interest rates to get to 5%. One of those things is the spread. Spread right now is so large that interest rates should be a whole 1 point lower just about. So we should already have interest rates in the 5s. And then as the economy cools and as the Federal Reserve starts making these rate cuts, which the projected is practically a 100% chance in the month of September, there's going to be more and even more in 2025, we could definitely plausibly get down to 5% interest rates. And if it doesn't happen 25, it happens 26. But let's say that the median home price stays the same at $900,720. The median income, we're extrapolating it to grow to about $95,700. Remember, these are estimates based upon the annual trend for how much they grow. So $95,700, and the down payment would be still $180,150, but now the payment with 5% mortgage rate is $3,868. That's a whole heck of a lot better than $4,741. As a matter of fact, it's so much better that the payment, the percentage of the monthly income now, how much of it's being devoted to the monthly payment is now 48%. That's a lot less than where we were. It's not as good as where we were in 2000 when it got down to 36%, but it's definitely a step in the right direction. Can we get interest rates lower? A little bit. Not a whole heck of a lot lower than 5%. I can make an argument for it to get into about 4.75%, but a lot of different things have to happen. A lot of different variables have to be hit. And so we can't really prognosticate that far off. But there is definitely a pathway to get down towards 5%. You can see what happens. As interest rates drop, it just makes things more affordable. What this means is that if you need to have less of your income being devoted to the house price, you either have to make more money or buy a smaller house than $900,720 for the for what you're looking for. And that's the median home price in all of California. There are different markets, but there's also different median incomes for these different markets as well. So we track all that going down to the granular level. And this applies to California, it applies to United States, to Nevada, to Arizona, to all the different metros across the US. What we're really waiting for are interest rates to come down to make things more unaffordable. It's not as bad in other states as what I've just outlined for the state of California. This is like one of the worst case scenarios that are out there, but it still, it shows, it illustrates that while 1981 was expensive, it's even more expensive today, and it will only get better once interest rates drop a lot more down the road. So as far as all those people talking about interest rates being a lot higher back in the past, it really depends. It's not just about interest rates. It's about the home price. It's also about how much income you are making. So right now, because of how high the payment, the monthly payment to income ratio is at about 62%, it's really created low demand. And it's been low demand last year and this year. So it's very, very low demand. And you can imagine as interest rates fall further and further, what will happen? We'll see a spike in demand. We'll actually also see more homes come on the market because there are a lot of homeowners opting not to sell because they don't want to trade in their incredibly low fixed rate for a higher fixed rate and a higher monthly cost. So that is keeping a lot of homeowners inside of their homes. But as interest rates drop, we will see more homes come on the market, but we will see a lot more buyers come to the market. So as interest rates drop, demand will spike and it will be at a faster clip than the number of homes coming on. So that will be a recipe for a hotter housing market as interest rates drift downward. So If you want more information, go to reportsonhousing.com. If you like what you've seen, subscribe to our channel. It just helps out the YouTube algorithms. And the most recent report that we put together is called Subdued Summer. And that's out with all markets have received it, because we have one for Phoenix, we have one for Vegas, we have one for the Bay Area, we have all of SoCal, including Ventura. And so Subdued Summer, new reports start coming out next week for along the coast, Orange County, LA, San Diego, and Ventura. And if you want to subscribe and pick one of the counties that we have a report for, and you want a free month, utilize the coupon code SWIM, because that's what I need to do right now, because I just realized my AC is on the fritz. So I'm going to go swim, because that's the only way I'll be able to cool myself down. It's summertime. Use the coupon code SWIM for a free month. Thank you so much. I appreciate you tuning in to another housing debrief. I hope you have a fantastic finish to this week. It's already Friday, and have a fantastic weekend, and we will see you on the other side.